Welcome, everyone. Today we're going to talk about one of the most important retirement income decisions most people will ever make: Social Security. For many retirees, Social Security isn't just another benefit. It's a dependable income source that can last for life, adjust with inflation, and support a surviving spouse. But it can also feel confusing. There are claiming ages, benefit formulas, spousal rules, survivor rules, tax rules, and a lot of opinions about what someone should do. Our goal today isn't to tell everyone there's one perfect claiming age. The goal is to give you a framework so you understand the moving parts and can make a more confident decision. As always, this is general education. It's not individualized tax, legal, or financial advice. Your personal claiming strategy should be coordinated with your broader retirement plan. Here's where we're headed. We'll start with the basics: how Social Security is funded, how you qualify, and how your monthly benefit is calculated. Then we'll move into dependent benefits, including spousal benefits and benefits for eligible family members. After that, we'll cover survivor benefits, which are often one of the most important pieces of planning for married couples and widows or widowers. Finally, we'll close with special considerations: divorce, the repeal of WEP and GPO, taxation of benefits, what happens if you change your mind, and the practical action items to take after today. The theme throughout is simple. Social Security isn't a standalone decision. It should be integrated into your income plan, tax plan, investment plan, and family plan. Before we get into the numbers, it helps to remember what Social Security was designed to do. Social Security was created in 1935. At first, benefits were limited, but over time, the system expanded to include monthly benefits, spouse benefits, benefits for minor children, survivor benefits, and cost of living adjustments. The timeline on this slide is a useful reminder that Social Security has evolved many times. Rules have changed, taxation has changed, full retirement ages have changed, and the funding sources have broadened to include payroll taxes, interest on trust fund treasury securities, and taxes paid on Social Security benefits. So, when people ask whether Social Security will be around forever, the honest answer is that the program has a long history of change. That's why planning should be based on current rules, but flexible enough to adapt if rules change in the future. Now, let's move into the core mechanics. Social Security can seem complicated because there are many rules layered on top of each other, but the foundation is fairly simple. You pay into the system while you work, you earn credits toward eligibility, and your future benefit is based on your earnings history and the age at which you start claiming. As we go through this section, listen for three key ideas. First, whether you qualify. Second, how your benefit is calculated. And third, how the claiming age you choose can permanently change your monthly income. Social Security is funded primarily through payroll taxes. On your paycheck, this is part of FICA. The Social Security portion is called OASDI, and both the employee and employer pay into it up to the annual wage base. Medicare payroll taxes are separate, and unlike the Social Security wage base, Medicare taxes generally don't have the same income cap. Higher earners may also pay an additional Medicare tax. The point of this slide is that Social Security isn't a random government benefit. It's tied to a lifetime of covered earnings. For many people, every paycheck during their working years is gradually building eligibility for future retirement, disability, survivor, and dependent benefits. To qualify for retirement benefits, you generally need 40 work credits, which is commonly described as about 10 years of covered work. You can earn up to 4 credits per year. Once you've those credits, the next question isn't whether you qualify, but how much your benefit will be. Your benefit calculation uses your 35 highest earning years, adjusted for inflation. That's important. If you've fewer than 35 years of earnings, Social Security enters zeros for the missing years. For someone who took time out of the workforce, worked part-time, or retired early, those zeros or lower earning years can affect the final benefit. This is also why your Social Security statement is worth reviewing. It gives you a record of your earnings history and estimated benefits at different claiming ages. There are two terms that come up again and again: full retirement age and primary insurance amount. Full retirement age, or FRA, is the age when you're entitled to your full retirement benefit. For many people approaching retirement today, full retirement age is somewhere between 66 and 67, depending on year of birth. For those born in 1960 or later, it's age 67. Primary insurance amount, or PIA, is the monthly benefit you would receive if you claim exactly at full retirement age. This matters because every claiming decision is measured against that PIA. Claim before full retirement age, and your benefit is reduced. Claim after full retirement age, and your benefit can increase through delayed retirement credits up. To age 70, inflation enters the Social Security conversation in two ways. First, your past earnings are indexed. In other words, Social Security adjusts older earnings to make them more comparable to today's dollars when calculating your average indexed monthly earnings, or AIME. Second, once you're receiving benefits, annual cost of living adjustments, or COLAs, can increase the benefit over time. The table shows that COLAs have varied significantly from year to year. Some years have been zero. Other years, such as 2023, were much higher. The planning takeaway is that Social Security has an inflation-adjusting feature that many other income sources don't have. That doesn't mean it covers every cost increase perfectly, but it's one reason Social Security is such a valuable part of a retirement income plan. This slide shows the basic formula for calculating a monthly PIA. The example uses Alvin, whose monthly AIME is $11,000 in 2026. Social Security applies different replacement rates to different layers of earnings. The first layer is replaced at a high percentage, the middle layer at a lower percentage, and the final layer at an even lower percentage. That structure is intentional. Social Security is progressive, meaning it replaces a higher share of income for lower earners than it does for higher earners. In Alvin's example, the calculation produces a PIA of $3,713. You don't need to memorize the bend points or do the math by hand. What matters is understanding that the benefit is tied to your 35-year earnings record and then adjusted based on when you claim. The earliest most people can start retirement benefits is age 62, but claiming early comes with a permanent reduction up to 30% if your full retirement age is 67 and you claim at 62. That doesn't automatically mean early claiming is wrong. There are legitimate reasons someone might claim early. Maybe they retired earlier than planned and need income. Maybe their health or family history suggests a shorter life expectancy. Maybe the strategy is being coordinated with a spouse's benefit, dependent benefits, or a desire to preserve other assets. The key is to avoid claiming simply because 62 is the first available age. The claiming age should be a planning decision, not just a calendar decision. This chart illustrates how powerful claiming age can be. In the example, the full retirement age benefit is $3,000 per month at age 67. If the person claims at 62, the benefit is reduced to $2,100 per month. If they wait until age 70, the EI benefit rises to $3,720 per month. That difference is meaningful. Waiting from full retirement age to age 70 increases the benefit by 8% per year. But the trade-off is that you receive fewer years of checks. So this is really a longevity, cash flow, tax, and investment decision. When you look at this chart, focus less on finding a universal best age and more on understanding the trade-off, lower income sooner or higher income later, if you claim Social Security before full retirement age and continue working, the earnings test may apply. This is one of the most common surprises for early claimers. If your wages or net self-employment income exceed the annual limit, Social Security may withhold part of your benefits. The important detail is what counts and what doesn't. W-2 wages, 1099 contract income, and net earnings from self-employment count. Investment income, interest, dividends, pensions, annuities, and retirement plan distributions generally don't count for the earnings test. Also, once you reach full retirement age, the earnings test no longer reduces your benefits. If benefits were withheld earlier, Social Security may recalculate your benefit at full retirement age to account for months when checks were withheld. Joanne's example shows how the earnings test can affect real cash flow. She files at age 62 with a $2,000 monthly benefit, but she expects to earn $47,000 in 2026. The earnings limit is $24,480, so her excess earnings are $22,520. Because she is below full retirement age, Social Security withholds $1 of benefits for every $2 over the limit. That means $11,260 of benefits are withheld, roughly 6 months of Social Security checks. In practical terms, Joanne may not receive a check until July. This is why claiming early while still working needs careful planning. The issue isn't just the permanent reduction, it's also whether benefits may be withheld during the years before full retirement age. Longevity is one of the hardest parts of Social Security planning because none of us know exactly how long we'll live. But this chart gives useful perspective. If you reach age 65, there's a meaningful probability of living into your late 80s or 90s, and for couples, the probability that at least one spouse lives to an advanced age is even higher. That matters because Social Security is a lifetime benefit. A higher monthly benefit can become more valuable the longer you live. This is especially important for married couples because the higher benefit may also become the survivor benefit later. So when we discuss claiming, we're not just planning for the first few years of retirement, we're also planning for the possibility of a long retirement. Break-even analysis compares the cumulative dollars received under different claiming ages. In this example, claiming at 62 provides income earlier, but at a lower monthly amount. Claiming at 67 starts later, but the check is higher. Claiming at 70 starts latest, but the check is highest. The chart shows that the break-even age for claiming at 62 versus 67 is around age 78 and 7 months. The break-even for 67 versus 70 is around age 82 and 5 months. If someone lives past those ages, delaying may produce more cumulative dollars. If someone dies earlier, claiming earlier may have produced more. But break-even isn't the only factor. Portfolio returns, taxes, cash reserves, health, spouse coordination, and survivor benefits can all change the decision. Use break-even as one tool, not the entire plan. Next, we'll move beyond your own retirement benefit and look at benefits that may be available to family members. This is where Social Security becomes more than just an individual income stream. Spouses, minor children, disabled adult children, certain caregivers, and in some cases dependent parents may qualify for benefits based on a worker's record. These rules can be especially important for blended families, later-in-life children, spouses with very different earnings histories, or households where one person has been the primary earner. This slide introduces two ideas: who may be eligible and how the family maximum works. Eligible dependents can include spouses, children under 18 or 19 if still in high school, disabled adult children, spouses caring for a young or disabled child, and dependent parents. But Social Security limits the total amount payable on one worker's record through the family maximum. In this example, the worker's own benefit is $3,000 and the family maximum is $5,290. That leaves $2,290 to be divided among eligible dependents. The worker's own benefit isn't reduced by the family maximum. The limit applies to the additional dependent benefits payable on that worker's record. Spousal benefits are designed to help a lower-earning spouse receive a benefit based on the higher earner's record In general, the lower-earning spouse must be at least 62. The couple must have been married for at least 1 year. And the higher earner generally must have filed for their own retirement benefit. At full retirement age, the maximum spousal benefit is 50% of the higher earner's PIA. But if the lower-earning spouse claims before their own full retirement age, the spousal benefit can be reduced. A key point: spousal benefits don't grow with delayed retirement credits after the spouse reaches full retirement age. That's different from a person's own retirement benefit, which can continue growing to age 70. This slide addresses a common misunderstanding. If you qualify for both your own retirement benefit and a spousal benefit, you generally can't choose one while letting the other grow. This is called deemed filing. Social Security will typically pay your own benefit first, plus any spousal excess needed to bring you up to the higher amount you qualify for. The table shows how percentages change based on claiming age. Claiming early can reduce both your own retirement benefit and the spousal portion. Waiting past full retirement age may increase your own retirement benefit, but it doesn't increase the spousal portion above the full retirement age amount. That's why spousal planning often requires looking at both spouses together, not separately. William and Kate's example brings the spousal rules together. William's PIA is $2,000 and Kate's PIA is $500. Kate may be eligible for a maximum spousal benefit of $1,000, which is 50% of William's full retirement age benefit, but only after William starts his own benefit. If Kate claims at 62, her own benefit is reduced, and the spousal excess portion is also reduced. In this example, that produces $675. If she waits until full retirement age or later, her own full benefit plus the spousal excess can reach $1,000. The lesson is that timing matters for both spouses. One spouse's decision can affect when the other spouse becomes eligible and how much they receive. Now let's turn to survivor benefits. This is one of the most important parts of Social Security planning, and it's often overlooked. When one spouse passes away, the surviving spouse doesn't keep both checks. In general, the survivor receives the higher of the two benefits, assuming eligibility rules are met. For couples, this means the higher earner's claiming decision can become a protection decision for the surviving spouse. A higher delayed benefit may provide more income not only during joint life, but also after the first spouse dies. This slide shows the basic survivor concept. Before death, one spouse may receive $2,500 and the other one $1,500. After death, the smaller check goes away, and the survivor may receive the higher benefit. In this example, the survivor benefit is $2,500. To qualify, the marriage generally must have lasted at least 9 months. The deceased spouse must generally have enough work credits, and the surviving spouse must meet age or caregiving requirements. A surviving spouse can begin as early as age 60, but if they claim before survivor full retirement age, the benefit may be reduced. For many households, this is a major cash flow change. Expenses may not fall by half when one spouse dies, but income can fall significantly. If a surviving spouse claims before survivor full retirement age, the survivor benefit is reduced. The table shows the percentage of the deceased spouse's benefit payable at different starting ages. At age 60, the survivor may receive 71.5%. At survivor full retirement age, the benefit can be 100%. Also remember the earnings test. A surviving spouse who is under full retirement age and still working may have benefits withheld if earnings exceed the limit. This is why survivor planning often requires balancing immediate income needs against the value of waiting for a higher survivor benefit. The survivor benefit also depends on whether the deceased spouse had already started benefits. If the deceased claimed early, the survivor generally receives the greater of what the deceased was receiving, or 82.5% of the deceased's PIA, sometimes referred to as the widow's limit. If the deceased claimed at or after full retirement age, the survivor can generally receive the actual benefit the deceased was receiving, including delayed retirement credits. If the deceased had not claimed yet, the survivor benefit depends on whether the deceased was under, at, or beyond full retirement age at death. The practical takeaway is that one person's claiming age can affect someone else's future survivor. Income. Sally's case study shows that survivor benefits and retirement benefits can sometimes be coordinated. Sally is 60. Her own PIA is $2,800, and Tom's PIA was $3,000. The chart compares different claiming strategies over a 25-year period. One option is to claim survivor benefits immediately at age 60. Another is to claim Sally's reduced retirement benefit at age 62 and switch to survivor benefits at full retirement age. A third is to claim the reduced survivor benefit at 60 and switch to Sally's own retirement benefit at 70. The best strategy depends on her need for income now, health, life expectancy, work plans, tax situation, and whether her own benefit can grow meaningfully by waiting. The big lesson is that survivor benefits and retirement benefits aren't always an either-or decision forever. In some cases, there may be a switching strategy. Now we'll close with several special situations. These don't apply to everyone, but when they do apply, they can materially change the Social Security decision. We'll cover divorce benefits, the repeal of the windfall elimination provision and government pension offset, taxation of benefits, how all of the claiming factors fit together, and what to do if you change your mind. A divorced spouse may be eligible for benefits on an ex-spouse's record if certain requirements are met. In general, the marriage must have lasted at least 10 years. Both individuals must be at least 62. The person claiming must be unmarried, and they must not qualify for a higher benefit on their own record. If the divorce has been final, for at least 2 years, the ex-spouse doesn't need to have filed for benefits yet. If it has been less than 2 years, the ex-spouse generally must already be receiving benefits. Also, divorced spousal benefits generally stop if the claiming spouse remarries. For people who were married for a long time and then divorced, this can be an important planning item to review before claiming. This slide highlights a significant change affecting certain public sector workers and retirees. The Windfall Elimination Provision, or WEP, previously reduced Social Security benefits for some workers who had a non-covered pension and also earned Social Security credits. The Government Pension Offset, or GPO, previously reduced spousal and survivor benefits for some people receiving a non-covered pension. Under the repeal described in this deck, full benefits are now available without those WEP and GPO reductions. This can be especially relevant for teachers, firefighters, police officers, government employees, and others who may have worked in systems that didn't pay into Social Security for part of their careers. If this might apply to you, don't assume. An old estimate is still correct. Review your updated Social Security record and coordinate with the Social Security Administration. Social Security taxation is based on provisional income. The formula starts with adjusted gross income, then adds tax-exempt income, certain excluded foreign income, and half of your Social Security benefit. That total determines how much of your benefit may be taxable. For some households, Social Security isn't taxed. For others, up to 50% or up to 85% of the benefit may be taxable. This is one of the reasons retirement income planning and tax planning should be done together. IRA withdrawals, pension income, capital gains, interest, and other income can all affect how much of Social Security is taxed. You'll receive Form SSA 1099 each year for tax reporting, but the planning should happen before tax time. At this point, you can see why Social Security is more than a simple age decision. The right strategy depends on longevity and health outlook, income needs, coordination with a spouse, taxes, employment plans, break-even analysis, survivor, goals, and legacy priorities. For one person, claiming early may make sense because income is needed and health is uncertain. For another, waiting may make sense because they have other assets to bridge the gap. they are in good health, and they want a higher survivor benefit for a spouse. The goal isn't to chase the highest possible monthly number in isolation. The goal is to choose a strategy that supports long-term security, cash flow, flexibility, and your broader retirement plan. Social Security does offer limited do-over options, but the rules are specific. If you've received less than 12 months of benefits, you may be able to withdraw your application, repay the benefits received, and restart later. If you've received benefits for more than 12 months, that do-over option is generally not available. Once you reach full retirement age, you may also be able to voluntarily suspend your benefit. During suspension, delayed retirement credits may increase the benefit until age 70. The practical action item is to create or review your online account at ssa.gov. Confirm your earnings record, review your estimates, and use the calculators. To test different claiming ages, you can apply online up to 4 months before your desired start date. Let's finish with the steps to take from here. First, confirm your benefits on ssa.gov and make sure your earnings record looks accurate. Second, estimate your claiming options at different ages. Third, if you're married, coordinate as a couple, because one spouse's claiming decision can affect the other spouse now and later. Fourth, integrate Social Security with your broader financial plan. That means looking at taxes, investment withdrawals, pensions, cash reserves, Medicare premiums, and survivor needs. And fifth, revisit the strategy regularly. Social Security planning isn't a one-time conversation. It should be part of your annual retirement income review. Before we close, remember that today's discussion was general and educational. Social Security rules, tax laws, and personal circumstances can be complex, and they can change. You should consult qualified professionals about your individual situation. Thank you for joining today. If you would like help thinking through how Social Security fits into your retirement income plan, your tax plan, and your overall financial picture, the next step is to schedule a conversation and review your personal numbers.